Okay, hello everyone, I'm James Harte and welcome to this Orbex live market analysis session. Now, the focus of today's session is of course the hotly anticipated FOMC meeting. Now, this is the first time that we've heard from the bank since July, and expectations have been dominating markets ahead of the meeting. However, before we move on to discuss those expectations and to look at the technical landscape in the major currency pairs ahead of the meeting, let's quickly recap what we heard from the bank in July to give us some context to what we've been seeing in the price action and to help ground our understanding ahead of the meeting. So, at the July meeting then, the Fed opted to maintain policy at current levels in line with broad market expectations. We had no update to the FOMC forecasts, and with no press conference following the meeting, the only means of communication available at the time was the statement accompanying the rate decision. So looking at the statement then, the Fed struck a positive tone in the statement, noting that near-term economic risks had diminished, with economic activity expanding at a moderate pace and the labour market having strengthened. Inflation, however, was noted as remaining low and likely to remain so in the near term, though expected to rise to the Fed's 2% target in the medium term as transitory effects fade. Looking at the domestic economy then, the Fed noted that household spending was growing strongly, though business fixed investment remained soft. Referring to the rate path, the Fed noted that they still see only gradual increases in the federal funds rate as being appropriate, though the actual rate path will depend on incoming data. Now, one particularly bullish development at the July meeting was seen in the voting split, which changed from unanimously in favour of keeping rates on hold to 9-1 in favour of keeping rates on hold, with Kansas City Fed President George voting in favour of a hike at July. So in all, the meeting passed as expected, with the Fed citing some small improvement in the outlook, downplaying risks from Brexit and confirming their data-dependent stance. So the US dollar spiked initially in response to the statement, though fell lower shortly afterwards, as with no reference to the potential timing of any rate move, markets were left split between a September and a December date for a further hike. So since then, of course, we have had the meeting minutes from the July FOMC. Now, the July FOMC meeting minutes unfortunately provided little in the way of further colour and no indication of the timing of the next rate hike, as members remained divided over whether to raise interest rates sooner or not. The minutes stated that near-term risks had diminished, leaving scope for a hike this year if economic data continued to point to a resilient US economy. On labour market conditions, most committee members saw relatively low risk that a further gradual strengthening of the labour market would generate an unwanted increase in inflationary pressures, but they still prefer to defer another increase until they were more confident that inflation was moving closer to 2% on a sustained basis. So the low levels of inflation there causing some hesitance among some of the Fed members. Finally then, some Fed officials raised concerns about Brexit, saying that it creates uncertainty about medium to longer run outlook for foreign economies that could affect economic and financial conditions in the United States. Now, since the July FOMC meeting, we've had plenty of key US data, which has been particularly market moving, given the Fed's reaffirmation of their data-dependent stance. Traders have been paying close attention to economic data out of the US as it's come in. However, for the most part, we can see that this data has actually underperformed expectations and highlighted weakening economic conditions in the US. So let's quickly recap what we've seen from the key data prints out of the US since that meeting. So second quarter GDP printed below expectations at 1.2% versus 2.5% expected. Second quarter personal consumption similarly undershot expectations at 4.2% versus 4.4% expected. Remember, the Fed used this as a key gauge for real inflation. The July ISM manufacturing and non-manufacturing components both printed below expectations. We did have a little bit of positivity coming out of labour market conditions then, with the July non-farm payrolls seeing 255,000 jobs versus 180,000 expected. However, July retail sales again pointed to weakness in the underlying economy, with a flat print versus 0.4 expected. Again, July core CPI, so this is the headline inflation reading, again was below expectations at 2.2% versus 2.3% expected. Some positivity again though with July durable goods, which printed 4.4% versus 3.4% expected. However, going back to that ISM manufacturing and non-manufacturing data in August, you can see that once again we had a contraction and both sets of data printed below expectations. The unemployment rate in August was shown to have ticked up from 4.8% and 4.8% expected to 4.9%. And alongside this, we actually saw some fallback in the August jobs report, with non-farm payrolls printing 151,000 versus 180,000 expected. Alongside this data then, highlighting weakness in earnings and employment, we had August average hourly earnings falling to 2.4% versus 2.5% expected, highlighting some weakness and stalled momentum in wage growth. Again, August retail sales just highlighting that weakness, printing minus 0.3% versus minus 0.1% expected, before finally we ended on a slight positive note with August core CPI printing 2.3% versus 2.2% expected. So clearly a lot of data weakness there, and really the only positive data that we've seen in that series has been the strong July NFPs, which obviously fell back again in August, and then the better than expected August CPI. Crucially though, the ISM manufacturing and non-manufacturing data has undershot expectations for the second consecutive month, with retail sales similarly falling for a consecutive month. So the data highlighting a lot of weakness there in the underlying economy and causing some disparity in expectations against what various Fed members have been saying. And of course, over the last 2 months, we've heard from a raft of Fed members who have voiced their opinions on the prospects of a rate hike and the likely US rate path for the remainder of the year. And these commentaries have been just as watched as the data prints have and caused just as much volatility. So let's quickly recap what we've heard from the Fed members and try and get a gauge of what we can expect out of the FOMC this evening. So the majority of these comments have actually been in support of a rate hike. Fed's Williams noted that the economy has climbed back to full strength and it therefore makes sense to move monetary policy gradually back to normal, adding also that in the context of a strong economy with good momentum, it makes sense to get back to a pace of gradual rate increases, preferably sooner rather than later. Fed's Bullard also spoke in support of a hike, noting that he can see 2 rate hikes as possible before the year end. We then had Fed's Rosengren, who traditionally has been seen as a dove, actually urging for action sooner rather than later, saying that a failure to continue on the path of gradual removal of accommodation could shorten rather than lengthen the duration of this recovery. Fed's Fisher, then, another proponent of hiking sooner rather than later, noted that we are close to our targets and that looking ahead, I expect GDP growth to pick up in coming quarters as investment recovers from a surprisingly weak patch and the drag from past dollar appreciation diminishes. So these comments again further increased rate hike expectations. Fed's Meister reiterated comments made by Fed's Rosengren, noting that if you inappropriately keep interest rates too low for too long, then you put yourself in a position of perhaps having to raise interest rates more strongly in the future, adding that she feels there is a compelling case for raising rates. And this is one of the main arguments that US hawks are using at the moment, which is that if they can raise rates now, then they afford themselves more optionality instead of leaving it too long and having to raise rates too acutely in future. Now, there are, of course, divisions among the Fed, and alongside these hawkish comments, we've also had arguments against raising rates. So we had Fed's Brainard urging caution in the removal of accommodative monetary policy, adding that the case for preemptively tightening is less compelling. These comments were then backed up by Fed's Powell, who also urged patience and the need for weight to inflation to move back to target. So as we saw in the July FOMC meeting minutes, with some Fed members citing concern about the subdued levels of inflation. So this is obviously a key factor which is causing a problem for some Fed members in terms of considering raising rates at this juncture, is the fact that inflation still remains at such low levels. Headline comments over the period then, of course, came from Fed Chair Janet Yellen, who, speaking at the Jackson Hole Symposium at the end of August, noted that in light of the continued solid performance of the labour market and our outlook for economic activity and inflation, I believe the case for an increase in the federal funds rate has strengthened in recent months. Now, obviously, since those comments were made, we have, of course, had the disappointing August NFP results out. And so it's going to be interesting to see how that data weighs into her decision-making process and how that affects the overall dynamic of the group decision this evening. So in considering expectations ahead of the meeting then, let's quickly take a look at COT positioning data for the US dollar to give us some context. So remember, this data is showing the positioning of non-commercial players in the market, e.g. the banks and institutions. And for those of you who follow the weekly COT update, you'll know that this data can be extremely helpful in helping us gauge market sentiment and establish directional bias. So just looking at this year alone then, you can see that we're down from the 2016 highs at the start of the year, just after the Fed had hiked, which means there is, of course, plenty of room for a bigger dollar bid to enter the market. Now, positioning over the last couple of weeks, or the last couple of months indeed, has been particularly fraught, and you can see that this has been reflected in the positioning data, where we had initial highs, then some pullback. We had further highs, and then we've since pulled back again. So positioning has been particularly choppy in the US dollar, with markets fluctuating around various economic data releases, and of course, these different viewpoints that we've had from different Fed members. So positioning and expectations ahead of the meeting have been particularly choppy, and this has created very difficult trading positions. Again, the disconnect between recent data and supportive Fed commentary has made it very hard for traders to get a proper gauge ahead of this meeting. Now, aside from just looking at the institutional data, we can also take a look at what the retail market are suggesting ahead of this meeting. So, if we look at retail positioning then, as shown by MyFX book, which tracks a broad range of live retail trading accounts, you can see that traders are mostly US dollar short heading into this meeting. So traders are predominantly short the dollar against the euro, short the dollar against the pound, short the dollar against the Canadian dollar. Obviously we'll discard sterling yen, but then looking at the dollar yen, you can see that traders are predominantly long, although I suspect that this is more of a short JPY play on the back of yesterday's Bank of Japan meeting. Now, looking at the CME group's pricing ahead of the meeting then, and you can see that they are in fact only pricing in a 15% chance of a hike at this meeting. So very subdued expectations, and these are down from around highs of 30% about 2 weeks ago. So in terms of the factors that are going to affect the Fed's decision-making process tonight, and the elements which are weighing in on the analyst discussion and industry discussion ahead of tonight's meeting and affecting positioning and directional bias. Let's take a look at what these are. So inflation has of course started to tick up recently. We saw that improved CPI print in August. However, inflation is still well below target level, and as we saw in the July FOMC meeting minutes, it is a clear cause for concern for many Fed members. Now, the recent uptick in inflation is likely to be an encouraging sign, and if momentum continues, this should further support the case for a rate hike this year. However, at current levels, inflation doesn't seem to warrant a hike in September. Labour market conditions, again, a little challenging. There has been some clear weakening with the pace of monthly job growth falling from around 250,000 jobs per month in the later half of 2014 to around 175,000 jobs per month over the last 6 months. And again, we saw that NFP print falling below expectations in July, printing 151,000 versus 180,000 expected. However, despite this deterioration in pace, jobs growth remains well above the Fed's sustainable rate, which is the level which maintains the constant gap between the unemployment rate and the natural rate. So although we've seen a little bit of weakening in the jobs market, many are suspecting that the Fed will overlook this as the level still remains above their sustainable rate. However, the growth picture is obviously more challenging. We've seen overall economic activity remaining at really modest levels this year. GDP growth currently sits at just 1.1%, and so is only marginally off the lowest levels of the last 4 years. The weakened business investment outlook for the remainder of the year also threatens to further weigh on growth, so this poses considerable challenges for the Fed. And then also alongside this and exacerbating the weakened business investment outlook is the prospect of the upcoming US election and the risks that this presents for the Fed. Now obviously the main concern that markets are considering at the moment is the potential election of maverick Republican candidate Donald Trump, who presents a great deal of uncertainty both for the market and for the Fed. Now, Trump has noted his intentions to boost fiscal stimulus derived from significant tax changes, which could boost inflation and thus warrant a steeper rate path. However, the Fed are likely to want to wait and see how the election plays out before committing to a course of action, especially since Trump has fallen back in the polls over the summer. So in summary then, ahead of the meeting, essentially not expecting the Fed to raise rates at this juncture, but are expecting a clear hawkish tilt to the statement in line with a lot of the sentiment expressed by Fed members over recent weeks. So expecting the Fed to outline that they are moving closer to raising rates and foresee a rate rise before the year end, which ultimately should provide support for the US dollar. Now, of course, there is an outsider scenario, and that is that the Fed raises rates at this meeting with a view to giving them greater optionality to move at a much more gradual pace and avoid the need for steeper tightening in the future. So this would, of course, be what we would consider a dovish hike, whereby the Fed moves now to avoid having to move at a steeper pace in future. So that's the outsider scenario, but as I say, the base case here is expecting the Fed to remain on hold with a statement which gives indications that they are moving closer to raising rates and that a rate rise is foreseen before the end of the year. So with that in mind then, let's take a look at the charts and scope out the technical landscape ahead of the meeting. Okay, so looking first of all at the US dollar index, and we're on the weekly chart here, and you can see that we have some really clear technicals carved out. So first of all, we're still trading in this range which has lasted since late 2014 now. So we obviously have the big double top at the 100 level, which is providing clear resistance for the range, and then clear support at the low end at this 92 level, providing the bottom end of the range. Now, looking at the price action over this year, you can see that we've been moving within this broad bearish channel scoped out by this bearish resistance line here and this bearish support line. However, since around May, you can see that we've actually recovered and the US dollar index has been trading higher, and we've been grinding higher within this really clear corrective bullish channel. So at the moment, what we essentially have is this corrective bullish channel within a broader bearish channel. So there is the potential here, considering the technicals alone, that we have a bear flag setting up, and we could expect the dollar to fall out through the bottom of this bullish channel support and head back down to test key structural support at the 92 level. However, going back to our base case scenario for the meeting, which is for the Fed to remain on hold but give hawkish signals, then the key area that we are looking for to signal a shift in sentiment to the top side is really a breakout beyond this bearish resistance trend line. So if we zoom in on this slightly, you can see this bearish resistance trend line is going to pose the key pivot for this upside move. So if the dollar can break higher from here, this is the key trend line to watch for resistance. And then of course we have key structural resistance at the July high of 97.64. So for now, still quite congested in this region. So we're obviously in the middle, the very middle of this range, but we do have two clear channels to track, which will give us a directional bias that we can look to use for our own positioning. So we're either going to follow this bullish channel higher and break out above this bearish resistance line, or this corrective bullish channel is going to give way, possibly on FOMC disappointment tonight, if the market gets any sense that the Fed is backpedaling on recent hawkish sentiment, if the Fed expresses any concern about recent data. So generally any sort of dovish perception by the market on the FOMC tonight, then we could see the US dollar breaking down below that bullish channel support, and then of course we want to be targeting a move down into key structural support and the support line of the bearish channel. So let's take a look at the major currency pairs now and see what the technical landscape is there. So kicking off with the euro then. So looking at the euro, and you can see that essentially post-Brexit we have made this choppy grind higher. So we obviously put in a low around the 109 level, and since then we've traded back in a very haphazard fashion back up to mid 113s before retracing and falling lower. And again, we have some really good trend line analysis here which can help us get a gauge on the directional bias in the euro dollar. So of course, the first thing to point out is that we have this contracting triangle pattern in play. So you can see we have this longer term bullish trend line running from the November 2015 lows, and then the bearish trend line running from year-to-date highs. So this contracting triangle pattern is a very clear sign of congestion and consolidation in the market, potentially outlining the likelihood of a breakout. Okay, so again, going back to our US dollar base case, where we're anticipating that we get some US dollar upside on the back of this evening's meeting, then we could see this breakout happening to the top side. Now again, when we're considering the technicals, it pays to look at both sides of the coin. So although from a fundamental perspective, I'm anticipating that we get some dollar bullishness tonight, I will of course be looking at opportunities on both sides of the market to make sure that if our outsider scenario does develop, then we're not caught offside and we still have some opportunities to engage the market. So looking at the downside then, the first area of support which is likely to be a key zone for the euro dollar is this rising bullish trend line from the November 2015 lows. So if we get that dollar topside break and the euro trades lower, you can see we also have some symmetry confluence there. Let me just quickly change the color of this line so you can see it more clearly. Okay, so you can see we have this corrective ABCD pattern completing into this bullish trend line support. So this would be a good interim level to look for the euro dollar to move to the downside. So again, if we do get this dollar topside break tonight, however, I feel that this level is probably a little too close to the market to actually halt any decline that occurs. So again, if the dollar breaks higher tonight, if the Fed give hawkish signals, then it's unlikely that the euro is going to stall out a mere 50 pips below current levels. And the bigger level, which I'd actually be looking at to provide better support, would be a move down into the June and July lows of around 109 to 109.70. So you can see we have this big structural low in place here. And obviously if we break lower tonight on a dollar topside move, then this is going to be the key pivot for the euro. We're either going to form a double bottom into this area and then rotate higher, or we're going to break below and then we can look to use a retest of this broken support to position for a further move to the downside. And actually, if we just zoom out on the euro here, again supporting this idea of dollar bullishness from the technical perspective, you can see that we have this really nice head and shoulders pattern. So for those of you familiar with chart patterns, you can see we have the left shoulder here, the head here, and then our right shoulder over here. So essentially, a breakdown of this bullish trendline support would in fact represent a breakdown of the neckline of this broader head and shoulders pattern, suggesting room for a fuller move down south. So a very clear technical picture there to keep an eye on. And if we do break that trend line, we are of course looking at the 109.70, 109.20 area as being the key pivot for price. If we bounce there, then obviously we can expect a test of this broken bullish trend line. However, if we break beneath, I'll then be looking for opportunities based on a sustained retest of this level to position for a move lower. Okay, so I won't be looking to play the initial breakout of this level, as I feel this zone is probably going to be quite a high interest area and we're likely to see a little bit of false action on the first test. But if we do test this area, trade higher and retest the underside of the broken bullish trend line, then I will be looking to play the next breakout. Alternatively, if we break down lower below this support level, I'll then be looking for a retest of that zone and a sustained move to position for a move lower. Now, of course, to the top side then, if the FOMC fails to satisfy dollar hawks tonight, and we actually see the dollar falling lower and the euro moving higher, well then the clear level which we want to keep on our radar is this bearish trendline resistance here. So you can see that for now, whilst price has fallen out of this interim bullish channel, we have in fact held a double bottom here and we're putting in a bullish pin bar candle on the daily. So this could be quite an important technical development here. And if price does trade higher, I'll be looking for a breakout above this bearish trendline resistance, targeting a move to the top side. Now, one thing to bear in mind is that this 113, this late 113, 114 level, you can see has been a really important resistance level for the euro over the last year and a half. So you can see that nearly every time we've traded into this level, we've seen a sharp reversal coming shortly afterwards. So this is a really important technical level for the euro, and if we can see a sustained move above that level, then this is a very important technical development, portending further upside in the euro. So those are the levels I'm looking at with the euro. Let's move on then to look at cable. Okay, and sterling, you can see that following the September Bank of England meeting, which saw the bank indicating the likelihood of further easing in November if the November forecasts are in line with August forecasts. On the back of that meeting, we have in fact seen sterling sell off quite sharply and trade all the way down into the bottom of this corrective bullish channel, which is where price is currently stalled. Now you can see that we also have some really clear symmetry support at this level with these two swings of equal length. So this is an important technical juncture for the sterling dollar, and obviously with key risk event in the offing with the FOMC tonight, going to provide the catalyst for either a breakdown below this bullish channel support where we open up a run down to test the year-to-date low at around 128, or alternatively, if the FOMC again fails to satisfy hawks tonight and we see the US dollar breaking lower, then we can expect this key technical support to hold and for sterling to rotate higher, and obviously the target on any long trade entered as price retreats higher from this trendline support is going to be a move back up to test the top of this bullish channel. So again, very critical for cable. at this point, and if the FOMC provides the catalyst for a breakdown in sterling, then the obvious level that's going to draw a lot of attention from the market is this year-to-date low at 128. So definitely going to be very interesting to see where cable shakes out on the back of the FOMC tonight. Moving on to look at the dollar yen then, and the dollar yen, a very interesting chart at the moment. Obviously last night we had the Bank of Japan's September monetary policy meeting, which saw the bank refraining from introducing any further rate cuts. However, they did introduce new policy framework, QQE, with yield curve control. And essentially, this sees the bank shifting focus away from expanding quantitative easing and instead onto targeting a steeper yield curve. Now, the reaction in the dollar yen was quite subdued. The reaction was far more pronounced in the crosses, where initially in response to the news, we saw heavy Japanese yen selling. However, once again, and as we've seen all year with these Bank of Japan meetings, the moves were ultimately reversed and the Japanese yen is now trading higher. However, in the context of this chart specifically, the key focus for traders is, of course, the FOMC decision tonight. Now, that being said, last night's meeting does lay some interesting foundations for this chart, because if the Bank of Japan are successful in the medium term in steepening the yield curve in the JGB market, this is ultimately a negative for the Japanese yen. And so if we do get hawkishness from the Fed tonight, then the road is definitely clear for a move higher in the dollar yen. Now, you can see at the moment the technical picture in the dollar yen is a very classic textbook bearish trend setup. So price has been respecting this really clear bearish channel all year, and we've currently stalled at key structural and psychological support formed at the 100 level. And we've actually fallen around 200 pips today to come back down and retest this 100 level for the fourth time since June. So again, as with sterling, we're at a very critical point here for the dollar yen. And if the FOMC fails to satisfy hawks tonight and we see the dollar falling lower, then this could provide the catalyst for a sustained break of that 100 level and year-to-date lows and a move down targeting the lower half of this bearish channel. Now, alternatively, if, as in line with our base case scenario, the Fed gives hawkish signals tonight and indicates that a rate rise is coming before the year end, then we can expect the dollar yen to break out above this bearish channel resistance line, which has capped price all year. And you can see that since late August, we've had 3 more tests of this level, and each time this line is held. So this is a really important technical level for the market. And if we can make a breakout above this bearish trendline resistance, then what I'd be looking for is a breakout above, a retest, and then an opportunity to trade to the top side. And the target that we should have in mind on any bullish play in the dollar yen is, of course, this symmetry move here. So again, the ABCD corrective pattern, which completes into around the July high here at 107.52. So if we do get a break higher in the dollar yen, I'll certainly be keeping my eyes on price action as we test that 107 level. This is likely to be the first area that we see some proper profit taking on the move, and we might in fact see some longer term trend traders stepping in to take price lower from there. So again, if we do see a break higher tonight and we break out above bearish trendline resistance, then we have initial structural resistance here at the August high of 104.38, and then beyond there we look to target a move up to 107.52 with the symmetry swing and confluence with this key structural resistance at the July high. So some really clear levels again there in the dollar yen. Moving on to the Australian dollar then. Okay, so looking at the Aussie, you can see that price is currently hugging the lower end of this broad bullish channel. So again, another corrective bullish channel which we've been moving in this year. You can see we have bullish channel resistance and bullish channel support. And then over the last couple of months, you can see that we've just started to form this triangle pattern, suggesting a waning of bullish momentum and a lot of indecision in the market. And again, going back to what we saw with the positioning data in the US dollar, which has been fluctuating around changing Fed rate hike expectations, well then this pair, as we've seen in the euro, has been held hostage to these fluctuating conditions and has failed to make any proper directional move. However, what we could have in place here ahead of tonight's meeting is a potential double top. You can see we have the primary high here and then the secondary high at this level. So if the Fed does satisfy hawks tonight and we get some indication that a rate rise is coming in the coming months, then we could expect quite a sharp move lower in the Australian dollar, such as we saw last week. So for those of you who are aware, last week as we saw the uptick in Fed rate hike expectations and a rise in global bond yields, what happened is there was a sharp unwinding of carry trades held in commodity currencies. So obviously we got quite a steep move lower in the Australian dollar. So if the Fed does deliver hawkish signals tonight and the market gets a sense that we are moving towards a rate hike before the end of the year, then we could again see another sharp move lower in the Aussie dollar, and that would suggest that this double top is in play. Now the key area to play a short side break in the Aussie then is of course below the key structural support, local structural support at the 74.38 low, and you can see we also have confluence there with this bullish trendline support. So if price breaks down below this level, this is a good indication that there is scope for a test of broader structural support at the May low of 71.42. So some very clear levels there for the Aussie then. And again, the technical landscape in this chart suggesting here with the double top that if we do get that dollar rip higher, then the Aussie is going to move lower, and a break of rising trendline support and local structural support opens up the path for a test of bigger support at the 71.67 level. And of course, if we move down there, we then have to consider this bigger symmetry swing in the Aussie, which will be a target for longer term players. And you can see that takes us just into that zone as well. So this is going to be a key area of structural support for the Aussie dollar. So if we do get a breakout below this level, I'll be looking to trade to the downside, targeting a move down into this 71.67 level. But then from a medium and longer term perspective, this could be an area to initiate long trades based on the price action we see as price moves down into that level. So a really interesting chart, and I'll be keeping an eye on this then on the back of the FOMC tonight. Now again, in terms of considering the other side of the coin, if the FOMC fails to satisfy hawks and we get a move lower in the US dollar tonight, which again isn't the base case scenario but could happen, and this is why we want to prepare by looking for different technical scenarios, then the key level that we really want to consider with the Australian dollar is this longer term bearish trend line, which has run from late 2014 and has provided significant resistance for the Australian dollar since that point. So over the last 3 years, you can see we've had several tests of this trend line, and each time price has traded into the trend line, we've seen price rebuffed and turn lower. And you can see we tested it as recently as late August. So this is a really important technical level for the Australian dollar and a key price pivot. So if price breaks out above that level and we sustain a move above that level, then we will of course be targeting a move up into the bullish channel resistance line up ahead. So definitely a technical level to keep on your charts, and as I say, this has been a key price pivot point for the Australian dollar over the last 3 years. And if the FOMC fails to provide a catalyst for dollar upside at this juncture, if the market gets any sense of backpedaling on recent Fed hawkishness or any disappointment with recent data, then we could see a breakout above this bearish resistance line, targeting a move up into the top of this channel. Okay, looking at the loonie then, and again, a similar story to the Aussie, where rate has been weighed upon over recent weeks by the commodity currency carry trade unwind that we've seen on an uptick in Fed rate hike expectations and rising global bond yields. Now you can see that price has been moving in this broad bullish channel over the last 6 months or so. So we started the year with that heavy sell-off, but over the last 6 months you can see that we've been grinding higher in this corrective bullish channel, but we're currently stalled at key structural resistance around the 132 to 132.60 level. And I'm anticipating here that if we do get Fed hawkishness tonight, this is going to provide the catalyst for an eventual breakout above this level. Now this is a level that I've had on my radar for quite a while now, and I've been watching as we've moved up and around this level, testing into it several times, and the current pause at this level suggests that we have a bull flag formation. So if we chop down to the 4-hour chart, you can see that this block of consolidation at this level suggests that we do in fact have a bull flag, and there is a chance of price breaking out and trading higher. So if we do get Fed hawkishness tonight, I'll be looking to play a break to the top side. And my target for this move is going to be a move up into around this level here. So you can see, first of all, we have the nice symmetry swing here. So these two drives of equal length, which project up into around the 35.55 area. And just above that, you can see we have the bullish channel resistance line. And then if we bring in a Fibonacci retracement from year-to-date highs, you can see that we also have confluence there with the 50% Fibonacci retracement. So as we saw with the Aussie then, where we have some opportunities to play a short-term move and then look to change sentiment and get into a medium-term position, I'm anticipating that we get the same thing with the loonie here, whereby we get an initial breakout above this 32.60s level, we run as high as the 135.50s, and then we get some stalling there, and depending on price action, that could be a good opportunity to play to the short side, even if we're just targeting a retest of this breakout base. So I'll just remove that fib so you can see those levels clearly again. So that's what I'm looking for with the dollar Canadian. And then finally, let's take a look at the Kiwi. The Kiwi, a really interesting chart at the moment, because you can see, unlike the other commodity currencies, the Aussie and the loonie, we've actually managed to break higher this year. So the Kiwi has actually sustained bullishness and broken out. And you can see we've been trading within this broad bullish channel over the year. However, over the last few months, you can see that bullish momentum has started to wane and price action has started to stagnate, and we've actually got the formation now of a bearish wedge within the upper half of this bullish channel. So this is a clear, classic bearish reversal pattern rather, and a good indication that we could see a break lower. And again, this lines up with our fundamental bias, which is anticipating that we get some hawkish signals from the Fed tonight, suggesting that a rate hike is likely before the year end. So this ties in with what we're seeing on the technical landscape. And of course, we have that big bearish weekly pin bar in the Kiwi. So whilst this pin bar remains intact, I'm still anticipating that we get a break lower. So this was a really strong reversal candle that we got 3 weeks ago, and it occurred into the 78.6% retracement of the last leg down. Let me just go ahead and update the parameters there so you can see 78.6. Yeah, so you can see that that occurred into the 78.6% Fibonacci retracement of that last leg down within a longer term bearish trend. So this is a really nice corrective setup here, and this pattern suggests exhaustion of momentum within this corrective move and the scope for a rundown in the short term to at least test this bullish channel support. So if we do get dollar bullishness tonight on the back of a hawkish FOMC, then I will be looking to trade to the downside here in the Kiwi, targeting a move back down into this bullish channel support in medium term. Okay, so that's the technical landscape across the board in the major currency pairs then. We've looked at the recent data since the July FOMC. We've looked at institutional and retail positioning. We've considered the CME Group market pricing ahead of the interest rate decision, and we've also looked at the different scenarios considering base scenario and an outsider scenario. So I hope you guys have enjoyed this session, and I hope this has been really useful, and I look forward to updating you all on the back of the FOMC decision tonight. If you are trading around the decision, remember there is likely to be a lot of volatility, so look to highlight your levels in advance, look to manage your risk, and make sure that you don't get caught out in the volatility around the decision itself. So this is why it's always useful to conduct this sort of technical analysis ahead of the session and make sure that you have your bigger, broader levels marked out so you don't get sucked into chasing any moves unnecessarily. Okay, thanks a lot everyone, and take care now.